Hello everyone, welcome back to week 4 lecture videos. In this video, I will be briefly discussing an example of calculating NPV of a project. I will suggest that you can go through the textbook for any further details. First of all, the project has an initial investment of $10,000 and this is accumulated depreciation. So to calculate accumulated depreciation, first of all, you need to calculate yearly depreciation. So $10,000 is the initial investment and it has a salvage value of $500. Salvage value means the value at which the project is expected to be sold at the end of the project. So we deduct $500. So this is depreciable value, 9,500, and it's a 6-year project. So as we divide it by 6, yearly depreciation is 1,583. So this is 1,583. That's a yearly depreciation, and accumulated depreciation is the yearly depreciation is added up. Okay. Then year-end book value, this initial investment, that's the value of the project minus the depreciation on a yearly basis. So that's the end of year book value. And this is the working capital requirement of the project. As I previously mentioned, that when we take a project, it's not necessary that we only invest in capital asset, for example, land, building, machineries, or equipments. We also may need to invest in short-term assets and liabilities for the day-to-day operations of the project. So this is the working capital requirement of the project. For example, in year 1, we need a working capital of 550. For year 2, we need a working capital of 1,289, like this. But as a rule of incremental cash flow consideration, we will not consider this entire working capital as the requirement. We will only consider the changes in the working capital. For example, in zero period, we do not have any working capital. So in year 1, we need 550. So how much additional working capital is needed in year 1? 550. In year 2, we need a working capital of 1,289. So what we should assume that we need $1,289 of working capital, but from year 1, we already have $550 of working capital. So the additional working capital required in year 2 is 739. So the cash flow, a negative cash flow in year 2 will be 739, which will be the change in net working capital in year 2. Then we have total book value. Then these are the income statement information. We have sales, cost of goods sold, other costs, depreciation, and pre-tax profit. So how do we calculate pre-tax profit? This is our sale. You can see 523. So from these sales, as we deduct cost of goods sold, other cost, and depreciation, we get pre-tax profit. Then we deduct tax at 35%. So what we get is profit after tax. So which will be considered in calculating NPV. Now, cash flow analysis, because you know that we do not consider profit of a project, rather we consider the cash flows to calculate NPV. So this is our capital investment, $10,000, and you can say it's a negative number because it's an investment. And this is the change in net working capital. You can remember the working capital was 550 in year 2, so it's 550 negative because of working capital requirement. In the second year, it's 1,289, but as I already showed that the difference is the negative cash flow, so it's 739 negative, and it continues in this way. Then sales, cost of goods sold, other cost, and taxes. This is our operating cash flow. I already showed you how do we calculate this operating cash flow. Then we calculate net cash flow. How do we get this net cash flow? This is the capital investment, then our change in net working capital, and finally our operating cash flow. So as we consider these capital investment, change in net working capital, and these operating cash flow. As we add them up, we get net cash flows. Okay, and we discount these net cash flows with a discount rate of 20%. So these are the present values, and as we sum them up, we get net present value, which is 3,520. And you see that net present value is positive, so we will accept the project. Now a little bit details of the calculation. So from this income statement information, how we calculate cash flows, first of all, we have sales, and this is our cash inflow. Then cost of goods sold, other costs, and taxes, those are our cash outflow. So from this cash inflow, which is 31,110, which is cash inflow, that actually comes from deducting the cash outflows from the sales to get the cash inflows. And how do we calculate working capital changes? You can remember we were given that a working capital is 550 and in year 2 it's 1,289. So in some problems you may not be given with this total working capital, rather you may be given the different components of working capital, for example, accounts receivable, inventories, and accounts payable. So from the change in these working capital accounts, we need to find out how much working capital changes will be required. For example, here, increase in accounts receivable and increase in inventory, net of increase in accounts payable is the change in net working capital, which is considered as the cash outflow for the project. We have previously seen that depreciation of the project is calculated on a straight line basis. So it's the simplest case of depreciation. The investment, which was $10,000, is divided by the life of the project after deducting salvage value. However, for the tax purpose, typically depreciation is calculated on a method which is called MACRS, Modified Accelerated Cost Recovery System. In that case, percentages of each year's depreciation is given. For example, if it's a 5-year recovery period, then depreciation will be calculated like this: 20% in the first year, 32%, 19.20, 11.52 in year 4 and 5, and 5.76% in the year 6. So in the case of 5-year recovery period, for example, in our case, initial investment is $10,000, so it will be depreciated using this rate on an yearly basis. Okay, so here you can see, for example, $10,000, so 20% is the 2,000, then 32% in the second year, so 3,200, 19.2% in year 3, 19.2% in year 2, so 1,920, and 11.52% in year 4 and 5, so 1152 in year 5. So this is how depreciation is calculated, and then we have, as we deduct this tax depreciation, other cost of goods sold from sales, we have pre-tax profit, and on those pre-tax profit we calculate taxes. So this is the revised cash flow analysis after considering those all these factors, and you can see that net present value, and it's still the process is the same, and since it's a positive net present value, we accept the project. So this is a brief discussion on how we estimate NPV of a project given the cash flow, income statement, and the balance sheet information are given. And as I previously mentioned, that for any further detail you can read the textbook and this particular section carefully, okay, because that will especially help you in solving your assignment problem. Thank you very much.